Hey, Professor Mike. What are we learning today?
Hey there, and welcome back. It's Professor Mike again, and I'm here to talk to you today about the 4 major financial statements. The first major financial statement is the income statement. At its simplest, the income statement reports revenues and expenses of an organization, leading to a net income or loss for a period of time. The statement of changes in equity, well, that represents how much of the assets belong to the owner. The balance sheet, it reports assets and liabilities and equity at a point in time. Isn't that funny? Sounds a lot like the accounting equation. And the statement of cash flows reports the sources and the uses of cash for a period of time. So, income statement, statement of changes in equity, and statement of cash flows are all for a period of time, and the balance sheet happens at a point in time. Here's a sample income statement from Apple Incorporated. It's a company, I think they make phones or computers or something. You might know them. From way back when the world was a lot simpler in 2010, 2011. You can see we've got their sales, cost of goods sold, gross margin, some of their expenses, and their net income. Yes, those numbers are in millions of dollars. So 25,000 million, which is about $26 billion in 2011. Definitely gone up since then. As you can see, this is for the years ended 2011 and 2012. That's the period of time, that's a 1-year period that is run for 2011 and for 2010. And it's compared there so that you can actually see the difference in their financial performance. So again, a big company like Apple, at this time, I would wager that their financial statements were about 150 pages in length. This is their income statement. Very, very simplified. Now, a statement of changes in equity looks a little like this. We start off with our opening equity. How much equity did we have at the beginning? We then add our net income from the income statement. That's why we make that one first. And we add the owner's contributions. So, what did we start off with equity? How much did the company add to our equity through net income? How much did we add to our company through owner's contributions? We then take away net losses. Again, those are from the income statement. You can only either have one, either income or loss. So if we've made a loss, we take that away from equity. Or if we've withdrawn money from the company, we take that off of equity. And that gets us to our closing. So we've got our beginning, we add some things, potentially, we take some things away, potentially, and we end up with our closing equity. Again, you can see over a period of time. Next up, we've got a balance sheet. This is a sample balance sheet from Colgate-Palmolive. It's a company that makes mouthwash and toothbrushes and a bunch of other things. And here you can see, again, for such a large company, quite a simplified balance sheet. Large financial statements, but simplified so we can understand what's happening. And look at that, it's our accounting equation. Assets, liabilities, and equity. Perfect, all broken down. Remembering that the assets exist, they're things that we've borrowed money or invested money to buy or to have so that we can earn revenues. Those liabilities are what we owe, and the shareholders' equity is the amount that we've invested in our company or business. In this case, it's a corporation. And the balance sheet is so called because it always has to be in balance. If you take a look here, our total assets equal our liabilities and shareholders' equity, just the same as the accounting equation. Next up, we have the statement of cash flows, and I can hear you sigh through the computer screen. Not covered in this course. This is something that you can look forward to in 121. For your interest, it lets you know the sources and uses of cash throughout a period of time. Incredibly useful for business. You might not believe this, but there are some companies that have great revenues but still go out of business because they can't manage their cash. In fact, you might know some people that have amazing incomes, but always seem to be strapped for cash. These problems aren't just personal or business, they're pervasive. So how do we build these statements? We always start with the income statement. So directly from the completed transactions of a company, the work that you're going to do in this course, the work that we're going to do together in this course, you're going to be able to prepare these statements from those transactions, from something we call a trial balance, and we'll talk about that later. So we start off with that income statement. That's our revenue minus expenses equals a profit or a loss. We're trying to make a profit. I'll tell you, in business, sometimes I was accidentally a not profit, but I really did want to make a profit every single year. So the profit or loss then makes its way down to the statement of changes in owner's equity. So you got your opening capital amount, you add that profit or deduct a loss, add any contributions, deduct any withdrawals, and that gets you the closing capital, that closing owner's equity number at the end of the period. And finally, that closing capital, that equity shows up if we look down below. Hey, is that the accounting equation? It is, but it's also our balance sheet. Assets on the one side, then liabilities, and equity drops down from that statement of changes in equity. Easy peasy. These are the three statements you're going to be able to build directly from those transactions that you're going to be working on throughout the next several weeks and months. I hope this helped. Bye now.